Okay, let's turn next to the market research problem, which probably will take a little bit longer because we will introduce a new concept which is related to Bayes' theorem and the updating of probabilities based on subjective information. But let's first illustrate the context. So assume a car company is considering a facelift for a model. With the current model, the company knows that it will make a profit of 2.1 million. The profits associated with the new model are uncertain and depend on demand. If demand is high, profits are 3, if it's medium, 1.5, and when it is low, 1 million. And the car company expects that the probabilities for demand to be high, medium, and low, that they are 0.3, 0.4, and 0.3 respectively. So you already know that a narrative is never really good to illustrate a decision tree. So let's draw it. And here we have the same information. So the company can decide to introduce the new model. Then it depends on Mother Nature whether demand will be high, medium, or low. The probabilities are 0.3, 0.4, and 0.3. And we can also see the payoffs. So that is a much nicer way of illustrating a decision problem. Okay, so the first question is, without any additional information, would you introduce the new model? So we calculate the expected payoff of the new model. And so we have to multiply 0.3 times 3, that's 0.9, plus 0.4 times 0.5, 1.5, that's 0.6, plus 0.3 times 1, that's 0.3, so the total is 1.8. Well, because the current payoff is 2.1, and the payoff of the new one is less with 1.8, without any additional information, the company will not introduce the new facelift. But how would things change if there were perfect information? And perfect information is a theoretical concept. And the way I like to illustrate it is to say, who's the only one who knows everything? Let's say that's God. And so if you could approach God, and you approach God initially with a probability of 0.3, that the demand is high. And now God will tell you the demand will be high. What will you do? Will you go with the new and make 3 million, or you go with the current and make 2.1? Well, obviously you go then with the new. But you also approach God with an initial probability that demand will be medium of 0.4, but now God tells you, demand will be medium. What do? Well, then you go with the current and make the 2.1. And you also approach God with an initial probability that demand will be low. And if God tells you now demand will be low, you will say, okay, thank you, I go with the current. So now, if we get the expected value of this perfect information, we do 0.3 times 3, because when God tells us demand will be high, we go with the new. So here 0.3 times 3. But if God tells us the demand will be medium, well, then we go with the current, and we do 0.4 times 2.1. And likewise, if God told us the demand will be low, we also go with the current, and we do 0.3 times 2.1. So the expected value of perfect information, and that's a very important concept, is 2.37. And because we know that if we go with the current, we definitely have 2.1 already for sure, our willingness to pay, WTP, for this perfect information is the expected value of perfect information minus what we have for sure. So that's the 2.37 minus the 2.1, which is 0.27 or $270,000. And again, the expected value of perfect information is a purely theoretical construct. So the world consists of imperfect information. And the world of imperfect information is somewhat run by consulting companies, and so therefore assume that the car company is considering to hire Marble Research, which is one of the nation's leading market research companies. For $150,000 they will perform a test market study on the car's facelift. And although Marble can't predict sales figures exactly, they will indicate whether it believes the facelift will be a success or a flop. So in other words, you can expect a report that will conclude with a sentence that says, after looking at all the data and all our tests, we believe that your car will be a success. Now that's good news. Or it will be a flop, which will be bad news. But it's not perfect information. It's just the assessment of some consulting company. So now the interesting question is, how much value could you get out of such a study? And would you be willing to pay $150,000 for it? So now we essentially have to calculate the expected value of imperfect information. And because because imperfect information is of lesser quality than perfect information, it has a lower value, and our willingness to pay is probably less than the 0.27, the 270,000 for perfect information. So the question is, are we willing to pay $150,000 for it? So now the consulting of the Marble company is essentially giving us a new decision tree. So now our decision tree looks like this. So we can either consult or not consult. If we do not consult, we know we make 2.1 million. But now if we consult, the Marble company will tell us, we think it is a success, or we think it will be a flop. Well, what we need to do is we need to somehow identify that probability. Okay, we'll do that later. But let's continue with the decision tree. So when we consult, Marble may come back to us and tell us it will be a success or flop. If they come back to us and tell us it will be a success, then we have to decide, shall we go with the new or shall we go with the current? If we go with the new, well, then we would like to know what's the probability that the demand is now high, given that the marketing company tells us success. So we need to determine that one too. Likewise, we want to know what's the probability now that the demand will be medium, given that the research company Marble tells us it will be a success. Likewise, we would need to know what's the probability now that the demand will be low, given that Marble tells us it will be a success. So the point here is, if the marketing company comes back to us and tells us, I think that your new facelift will be a success, well, that probably bumps up the subjective probability that you think the demand will be high. So that's good information. That should increase your initial probability, which was 0.3. So initially you thought if the demand will be high with 0.3, but now if Marble company comes back to you and says we think it is a success, well, that's good news, and you probably will update your subjective probability from 0.3 initially to something higher. Well, likewise, when the consulting company comes back to you and tells you it will be a flop, well, that's bad news. And then if you introduce the new model, the probability that you think the demand will be high, given that the research company tells you it will be a flop, it's probably going down. And the probability that the demand will be low is most likely going up. So this is what we need to figure out here. We need to figure out those probabilities. And in order to figure out those probabilities, we need a concept which is known as Bayes' theorem. So Bayes was a statistician who lived, I think, in the 18th century, and he came up with the theory, which is quite important. And it is related to conditional probabilities. And let's start with, we want to know what's the probability of A given B. So in statistical notation, we write probability of A given B. Okay, so given B, this is the blue set of observations. That's given B. And then what's the probability that's A given B? So this is the intersection of A and B. So this is the first part. So we can write this conditional probability as the probability of A and B. So that's the statistical notation. Technically, this what looks like an inverted U reads intersection, but colloquially you can say and. It's the probability of A and B relative to the probability of B. This is not Bayes' theorem yet. Bayes' theorem comes next. Okay, so this is pretty straightforward. So now let's say somebody comes along and says, oh no, what's the probability of B given A? Okay, so now given A, that's the orange circle, but the probability of B given that A is given, so that's again the intersection again of probability A and B. But now over the probability of A. Okay, so now I can rearrange this term and I can solve for the probability of A and B. So now from here it follows that the probability of A and B can be written as the probability of A times the probability of B given A. And now we just replace in the first term the probability of A and B, and that is Bayes' theorem. So if we plug in for the probability of A and B, the probability of A times the probability of B given A, and we divide by the probability of B, well, this second part now, that is known as Bayes' theorem. And you see what we did is we just replaced the probability of A and B. So what we will need a lot in solving this problem is to interpret something like this in terms of that. Okay. So now let's continue. So ultimately, what are you interested in? So you want to know, initially you thought that the probability that the demand will be high was 0.3, the probability that it will be medium was 0.4, the probability that it's low was also 0.3. But now you want to know what's the probability that the demand will be high given that the marketing company tells me it is a success. And now we just apply Bayes' theorem and we write the probability of high times the probability of success given high over the probability of success. So this is applying Bayes' theorem from the previous slide. The probability of A given B is the probability of A times the probability of B given A over the probability of B. So that is what we just applied. So we just apply to every single of those questions that you are interested in Bayes' theorem, because we want to know, okay, if marble comes back to us and tells us it will be a success, well, then I want to know what's the probability now that the demand is high. It's probably going up. What's the probability of medium? Well, don't know, but that the probability of low is probably going down. And the same, because marble could come back to us and tell us, we think your new facelift is a flop, and we want to know, what's the probability now that we think demand still could be high, given that the research company tells us it will be a flop. The same for medium and so on. So what you see here is just an application of Bayes' theorem. And some of those terms we already know. So we already know that we set the probability of high. Initially we thought that was 0.3. Probability of medium was 0.4. Probability of low was 0.3. And here again 0.3, 0.4, 0.3. But the rest we still need to identify. So again, what I just inserted was information given from the very beginning. Okay, so now what you see, the probability of success given high, the probability of success medium, those are subjective probabilities. So you somehow, as a manager, need to decide if that marketing company looks at my facelift. They somehow, in their black box, they think, demand for this new facelift will be high. And then they will determine, what's the probability that when marble thinks that the facelift will lead to high demand, that they recommend success. That's probably very high. But how high it is, that depends on your subjective assessment. You need to evaluate that. Likewise, you need to think, somehow when the marble company looks at my facelift, they somehow think back in their mind, demand for the car will be medium. What's the probability then that they will recommend or that they will conclude their report with success? It's probably a lower probability than when they look at it and think it is high. So everything that you see here in green, those are subjective probabilities. And they are ultimately given. So, and you need to decide them. Okay, so let's just go back. Let's take a look at the first steps. And here you see again what we did already earlier. Ultimately, I want to know what's the probability that if marble company tells me that the facelift will be a success, that the demand will be high. So now I just plugged in here the probabilities from earlier. So what I just did here, you can see now on the next slide. What is now more important is, what's the probability of success given high, probability of success medium, and those are subjective probabilities, and they are given. So those are the ones. So let's assume that you as the manager think, well, if that research company takes a look at my new facelift and somehow they think that the demand will be high, they will conclude their report with success with a probability of 1. And likewise, they will conclude their report with a probability of flop of 0. Right? Because they need to sum up to 1. Likewise, or similarly, similarly, you think that if they look at the facelift and they think, demand for that will be medium, what's the probability that they will conclude success? Well, you think that probability is maybe 3/8. Then that implies that the probability that they will conclude with a flop, that must be 5/8, when the marble company somehow thinks that the demand for the new facelift will be medium. Finally, if you think that somehow when that research company looks at the new facelift and they think, oh my God, demand for it will be very low, you think the probability that they will conclude their report by saying success is very low, like 1/6. And likewise, then the probability that they will conclude the report with a flop, if they somehow think that the demand will be low, is 5/6. So the conditional probabilities in green, those are subjective probabilities that you as a manager or decision maker have about marble company. Okay, so now we can add this information to our conditional probabilities and Bayes theory. So we already know the probability of high, that was 0.3, but now the probability of success given high, that's 1, so that's 0.3. Then we plug in for probability of success given medium, that was the 3/8. So now we can already calculate the numerator as 0.15. Now the probability of low given success, so now we have to fill in the probability of success given low. Again, you think that this is 1/6. Then the probability of flop, given that marble thinks the demand for the facelift will actually be high, that's 0. So here the numerator becomes 0. Probability of flop given medium, that was 5/8. And the probability of flop, given that they think somehow there will be low demand, is 5/6. Okay, so now we already done with the numerator of Bayes theorem. So we know the only thing that's still missing is the probability of success or failure. Okay, but now we know there is a probability, given that they come up with success, there is one branch which is already here, the 0.3. So this is ending up with a probability of success, and here there is a probability that they come up with a success of 0.15, and here 0.5. So we basically sum up all the probabilities of success, which is the probability of I, and I is either high, medium, or low, times the probability that it is success given high. That will determine the probability of success. So that is 0.5. And maybe I can illustrate that later differently too. So, but the probability of success is 0.5. And it is the 0.3 plus the 0.15 plus the 0.5. Likewise, the probability of flop is 0 plus 0.25 times plus 0.25, that's also 0.5. And of course, they need to sum up to 1. So basically, we sum up all the conditional probabilities related to success. in the numerator. So the probability of high, so this is basically a decision branch, probability of high given success that ends up with a successful verdict by the marketing company. Okay, so now let's just continue quickly. So we always fill in the probability 0.5 for success, 0.5, 0.5. And now we can see that after we do that, we have now the probability of that we think that the demand will be high, given that the marketing company tells us it's a success, has gone up from 0.3 to 0.6. Likewise, the probability, if the verdict is we think your product will be a flop, then the probability that the demand will be low, given that they tell us flop, has now gone up from 0.3 to 0.5. Okay, so now we can add all the probabilities into our decision tree. So probability of success 0.5, probability of flop 0.5. And so now you see when we consult, the probability that they come up with a success is, then if the probability is 0.5, and then we have to decide, shall we introduce the new one. But now we think that the probability of the demand being high, given that the marketing company concludes it is success, is now 0.6. And the probability of medium given success is now 0.3. And the probability of low given success is now 0.1. And you see they sum up again to 1. So, and likewise for flop, we just have here now the updated subjective probabilities. Okay, so now the question is, let's say the marble company comes back to us and concludes it is a success. Do we go with the new or do we go now with the current? Well, so now we have to calculate the expected payoff of new given success. So this is 0.6 times 3, that's 1.8, plus 0.3 times 1.5, that's 0.45, plus 0.1 times 1, so that's 0.1. So now this is 2.35. Which is greater than the 2.1. So that means if the marketing company comes back to us and tells us we think you will be successful, then we can eliminate the decision current. But what if the marketing company tells us it will be a flop? So now we have to calculate the expected payoff of introducing the new, given that they tell us it will be a flop. So now we have 0 times 3, that's 0. 0.5 times 1.5, that's 0.75. And plus 0.5. So that would be 1.25. But of course 1.25 is less than the current of 2.1, so we can eliminate the flop. So that means our final decision, the expected value of consulting is, or the expected payoff of consulting, that is now 0.5 with a probability of 2.35. I mean, a payoff of 2.35 if you go with the facelift, plus 0.5 times 2.1. Okay, so now how much is that? Let me pull up my calculator quickly. Okay, so now that is 0.5 times 2.35 plus 0.5 times 2.1. So now that sums up to 2.225. So this is essentially now the expected value from imperfect information. And I guess this is also shown on the next slide. So here that is just again the decision, the expected value of new and current when success. That was 2.35, not consult 2.1. So the decision is to go with the new. That is what we just did. The expected value of new and current when flop. So if the consulting company comes back to us and says it will be a flop, then the expected utility of introducing the new would be now only 1.25. And maybe that should be actually expected payoff to be consistent. Here the same. Expected payoff. Okay, so now we can decide. So this is our decision tree after backward induction. So you can see if we consult and we get success, well then we introduce the new. If we consult and the consulting company tells us a flop, then we eliminate the new and go with the current. So the expected value of consulting is what I also just calculated earlier, 0.5 with a probability of 0.5, a payoff of 2.35, and with a probability of 0.5, a payoff of 2.1. So that's only 2.225. So now the expected value of this imperfect information, if I could write it like this, so the expected value of perfect information, that was 0.27. And now the expected value of, I call that maybe imperfect, inf, that is now only the difference of the 2.1 and the 2.225. So that is 2.225 minus 2.1. So now we get here only 0.125. So this imperfect information has a lesser quality and therefore a lower value. And so we are only willing to pay $125,000 for those consulting services. And again, so we probably have to renegotiate the price. But what we have seen is that perfect information is more valuable than imperfect information. And the willingness to pay for Marble's imperfect information is only 0.125 or 125,000. So if Marble asks for 150,000 for the study, it would not be worth it. And you should renegotiate a price of less than 125,000. Okay, so I know this is a little bit complex, but we will do some more problem sets, and I'm very sure it will make sense once we practice that a little bit more often. So, okay, let's just stop here, and yeah.